Hello. Good morning, ladies and gentlemen, or good day or good evening, depending on whatever time you're watching this lesson. Congratulations to you all for finishing the previous chapter, as today we'll be starting with a new one. On today's topic and the rest of the chapter, everything is just pretty much very simple, as most of the things we'll discuss are very repetitive. You just need to pay attention to what we're speaking about and ask questions or make comments whenever you don't understand something. I am always available for that, and I'll definitely try answering and getting through as many um, emails as I possibly can in one day. Just bear with me, please. For any inquiries or subject or content related questions, just please send me an email on the email address below, or communicate with your class reps as they have direct communication with me. So whenever you have an issue, comment, or question, you can either email me or communicate with your class reps, and I'll definitely try to answer as many questions as I can. So in this new chapter, we will be looking at the forms of ownership. This chapter is divided into two parts, and for this week, we'll be discussing part one of this chapter. We will have a look at what ownership is, some of the terminology we will use, the factors to consider when choosing a form of ownership, the different types of forms of ownership, the characteristics, advantages, and disadvantages. All right, these are the content details for teaching and learning, as well as assessment purposes. So for this entire chapter, learners must be able to outline or name the factors that must be considered when choosing a form of ownership, define the meaning of different forms of ownership, explain, discuss, or describe the characteristics, advantages, and disadvantages of each form of ownership, distinguish or tabulate, differentiate, or compare the different forms of ownerships, identify forms of ownership from given case studies, scenarios, cartoons, or pictures, select a best form of ownership, and justify the reason for your selection. As I have mentioned before, this is one of the simplest chapters we'll do in grade 10 business studies, as a lot of things are very repetitive. So now, what is ownership? When we look at ownership, we look at the legal possession or control of property, right? These may include assets that are tangible or intangible. So when we look at tangible and intangible assets, we look at things that can be seen or unseen. All right. Tangible assets are those that can be seen and touched. So they have a physical existence, like a car or your diary, for instance. Whereas intangible assets are the complete opposite of what tangible assets are. These assets cannot be seen or touched. For instance, owning shares in a company. When you own shares in a company, you can't physically see those shares. And lastly, ownership is having rights over those assets. A good example for that will be your cell phone. You have the legal possession and control over it unless your parents confiscates them, or you know, whatever, for not doing the dishes. Obviously, your parents can confiscate your phone, but besides that, you have the legal rights and possession and control over that cell phone. All right. Your cell phone is also a tangible asset, and the rights over that asset are completely yours. If the phone wasn't stolen, for instance, which I hope wasn't, then obviously you own the rights to those, to that cell phone of yours. All right, these are some of the terminology we will be using throughout this whole chapter. Again, pay attention to how most of these are repeated. And like I said, we will be repeating most of these things that we're going to discuss. So most of these terminologies are going to be used everywhere in all the different types of forms of ownership. So you must just pay attention to that. All right. This will also make it easier for you to study for your tests or for your exams. Sorry for that. All right, so some of these terminologies include forms of ownership. So a form of ownership is the legal position of the business and the way it's owned, right? The legal position of the business and the way it is owned. We have continuity, which is to continue to exist even if a change of ownership takes place. So if you decide one day to change the form of ownership of your business, can your business have continuity? Your business can have continuity if it's a partnership or if it's a sole trader or whatever. Can your business or your company have continuity depending on the form of ownership that you have? And if you can change it whenever you want to, can it still have continuity as time goes on? We have surety, which is a person or business who accepts liability for the debt of another person or business. And then we have securities, which are shares and bonds issued by the company. We have limited liability and unlimited liability. These are opposites of each other. So limited liability are losses are limited to the amount that the owner has invested in the company. So if your company goes bankrupt and you've taken a loan from a bank, the bank cannot take your personal assets. They're only limited to taking whatever you've used that money to purchase whatever in the company. So they'll definitely take your company car, your desks, your computers, and so on. But they cannot take things like your house or your personal car and your cell phones and all of those things because your losses are limited. And unlimited liability is the complete opposite, where they can literally take all your personal liabilities, right? And then now we're looking at the different forms of ownership. We have sole trader, which is a company owned or controlled by one person who takes all the decisions, responsibilities, and profits from the business. And then we have partnership, which is an agreement between two or more parties that have agreed to finance and work together in the pursuit of their own common goals, right? And then we have personal liability companies, which is a voluntary association of one or more persons. So with this one, it's almost like a sole trader, but unlike this one, people volunteer to work in the company. And personal liability, we spoke about liability whereby you are personally liable for whatever happens in the business. For profits or losses, you are personally liable for those. And then we have partnership article, which is a document that contains exhaustive provision with regards to the matters concerning the business and the partners, right? And then we have the annual general meeting, or the AGM, which is a meeting held once a year where the shareholders receive a report stating how well the company has done. So every year at the end of the year, shareholders of a company come together, sit down and discuss what has been achieved for the year in the company, what losses they faced, the plans they have for next year's business plans, and so on. And then we have the audit, which is the process where an organization's accounts are checked to make sure its financial operations are honest. So when you bring someone into the company to audit your financial statements, this is to show or to have proof at the end of the day that your finances are being used well and no fraud is taking place or no one is stealing the money in your company. Okay, now we will look at the factors to consider when choosing a form of ownership. So say you want to open up business one day or start a company, that business or company will need ownership rights. So these factors are what you need to look at when choosing a form of ownership for your business or your company. These factors include the size and nature of the business, the way in which the business is controlled or managed, who bears the risks, how capital is going to be raised, how profit and losses will be dealt with, who is responsible for any debts made by the business, tax implications for profits earned by the business, the lifespan of the business, and the vulnerability of the business in terms of lawsuits. Like I said, we have different types, of forms of ownership, which we will look at each differently and individually as time goes on. Namely, these forms of ownership are partnership, sole trader, close corporation, personal liability company, private company, public company, state-owned company, non-profit companies, and cooperative companies. In today's lesson, we will mainly look at partnership. All right, so finally, the moment of truth, which we will be introducing our partnership. What is partnership? When we look at partnership, we look at the agreement between two or more people who combine labor, capital, resources towards a common goal. Partners share responsibilities of the business, and they share the financial and management decision of the business. A fun fact is that Microsoft and Google are partnerships, if you didn't know that. Okay, so now what are the characteristics of a partnership? In a partnership, there are no legal requirements to starting a partnership except for drawing up a partnership agreement. So when you and your friend come together, for instance, to start a company, there aren't really a lot of legal requirements for you guys to do that. No affidavits of what your finances are and so on and so on. All you need to do is draft up a partnership agreement to show who the partners of this company that you guys are both starting are and what your vision and mission of the company is. Right? Partners can combine capital and may also borrow capital from financial institutes. So the both of you come together, you each take out 50,000 rands, for instance, to starting your business. That's your starting capital, 50,000 rand from one partner and another 50,000 rand from another partner. But that may also not be the case because each partner can take out different capital to start up, you know. Profit is shared according to the partnership agreement. So if you take out 40% of capital to starting the company and your other partner takes out 60% to starting the company, whenever your profit comes back, one will get 40% and the other one will get 60% of the profit that you guys make. Partners share responsibilities and are all involved in decision making. Partners have unlimited liability and are jointly liable for the debts of the business. Remember, we discussed unlimited liability. So partners, if a company or your company goes into debt and you need to pay off anything or loan that you both took out, you are both jointly liable for these debts and you have unlimited liability. So they can go the extra mile of taking your personal assets, your cars, your house, your furniture, anything that you own just to pay up that debt that you have. Okay, there are no legal requirements regarding the name of the company. So when you have a company, let me take it back here. So if you look at some of these forms of ownership, we have close cooperation, whereby the company name needs to end with CC at the end. Say you have your partnership company is called Tepo and Tabo, your company doesn't really have to end with something. But if in a close cooperation, your company name, for instance, say it's Vaseline and it's a close cooperation. So we'll have Vaseline CC. That's how these forms of ownership works. So with partnership, there are no legal requirements regarding the name. So you can have Tepo and Tabo, and um, that'll just be the name of your company. Nothing more needs to be added to it and nothing less. It says here there are no legal formalities to start, only a written partnership agreement. That's what we discussed earlier. You don't need anything, just drafting up a legal partnership agreement to start your partnership. It has no legal personality, therefore has no continuity. So if you and your friend decide to start a partnership and one friend decides to leave, it's no longer a partnership because there's only one partner left. So your company automatically needs to shut down, or you can go now and start your own different company alone. But because you don't have a partner anymore, that means your partnership cannot continue anymore. Only partners in their personal capabilities pay tax. So there really aren't tax implications, if especially if you can't afford any. But those partners who are capable of paying tax, depending on how much they earn, they may do so. But another partner who is unable to pay tax is not subjected to doing so. Auditing of financial statements is optional. It's not compulsory for your company to have its financial statements audited. You know, you can have the option to do so if you want to check if your operations are honest and legal, but it's not compulsory for you to do so. Diversity, specialization, and different skills of partners can be used. So your partner can come from anywhere in the country. Both of you may be diverse in your own different way, and that may be a good thing because now you get to learn something from each other. And sometimes the both of you may have different skills, which is a good thing for your company as well. All right, now we're going to look at the advantages of partnership. Um, Partners can bring in extra partners at any time, right? They can bring extra partners at any time. So whenever you have, after starting your company, for instance, you can literally bring anyone else into the company to help you guys with the work that you guys do. All right, all partners have a personal interest in the business. Obviously, you're not going to just start a company or a business when you don't know what you want to do with it. So when you start a business or a company, you must have a personal interest in what you want to do, what you want to achieve, and the kinds of profits that you want to make at the end of the day. The workload and responsibilities are shared by partners, right? Because you have a partner, everything that you guys do together will be shared equally amongst each other. The workload that you guys have, you will share it. You will share um, the profits that you guys make, everything that you guys have in the company that you need to do, or everything that you get in return will be shared equally. Okay, not equally, but will be shared amongst each partner. Partners invest new capital into the business for financial expansion. So, whenever you want to expand your company, you may invest more capital into the company in order to do so. You don't need to wait for, well, sometimes you do wait for profits that you make in order for that to happen, because I mean, you do need to make money in order to expand your business. But whenever you need to expand your business, you may invest more into your company in order for that to take place. It is easy and expensive and inexpensive to establish, even with a written agreement. Because it's you and your partner, you're not investing into a company, but you're starting a company. You can start with any amount of capital that you guys have. It can be as little as possible or as much as you guys can possibly invest in your company. But it's very easy and very inexpensive for that to happen. Partners share profit and therefore are motivated to work harder. So, whichever profit that you make, say at the end of every month, you guys make 10,000 Rand profit. One partner, like I said, if one partner invested 60% into the partnership, the other invested 40%, then for the 50,000, no, the 10,000 Rand that you make at the end of the month, one will get 6,000 Rand, the other will get 4,000 Rand. So that money will motivate you to work harder to make more profits at the end of the day. All right, it says here partners share decision making and management of the company. Because this is a partnership, there's no higher party or lower party. You guys both work together, you share everything. Like I said, the management, the decisions of the company, those are jointly made together. Partners are not compelled to prepare a financial statement, a audited financial statement. Like I said, it's not compulsory. You may do so if you want to, or the company may choose not to do so. Each partner can focus on their own strengths when sharing workload. So, say one partner is good at accounting. So, they'll obviously be looking at the finances of the company. And then the other one is good at management. Now, they're managing their resources, managing their suppliers, and so on and so on. It'll depend on whichever strength that what partner has, and that's how they can share their work. There is no need to give another partner something that you know that they're unable to do, because at the end of the day, that's going to create major problems for your company if things aren't done well. So you mainly focus on what each partner is capable of doing best, and that's how you share the workload. Partners are taxed in their capabilities, which can lead to a lower taxation depending on the level of income each partner receives. Like I mentioned before, if you are able to pay tax depending on your income, then that's when you are implicated to do so. But if you are unable to, then you're not implicated to do so. But at the same time, tax is also going to be limited to how much you earn. So if you earn 10,000 Rand each month, and one partner earns 5,000 Rand each, 5,000 Rands each month, then the partner that earns 10,000 Rands will obviously be paying a higher tax amount than what the other partner will be doing. It says here there is no limit to the number of partners allowed in the partnership. Like we mentioned before, you can bring in as many partners as you want. Therefore, raising additional capital to finance further business expansion is easy, as there are no limits to the number of partners. So as many partners as you bring in, that's when you can have more capital to raise and to expand your business. Partners are capable or are able to put their knowledge and skills together and collectively make the best decisions. So, like I said, when you have when there is a diverse or diversity in the company, this makes it easier because everyone comes with their own different skills, innovative ideas, and so on and so on. So that also makes it a little bit easier to learn from each other, and you guys can be able to make the best decisions in terms of where you want your company to head, and so on and so forth. Partners are relatively easy to establish. If you have a common goal, you can literally start a partnership with anyone, but make sure it's somebody that you trust, because like I said, we do not want people stealing money into the company, but it's very relatively easy to establish. There are no formal requirements for creating and running a partnership. All you need is a written agreement from each partner in order for that to take place. And now we will look at the disadvantages of a partnership. Partners may not all contribute equally. As I mentioned before, one partner can contribute 6,000 Rand to a company, the other one can contribute 40, no, not 40, the other one can contribute 4,000 Rand if you guys want to start your company or business with, say, 10,000 Rand capital. One partner can contribute 6,000 Rand and the other one can contribute 4,000 rand. So it may not be equal sometimes, which is not a good thing, depending on how much profit the company will be making and how much the other partner may want to get back as their returns. There can be a lack of capital and cash flow. Like I said, depending on how much you invest, there may be a lack of capital and cash flow, also depending on what your business operations are. So if you are, for instance, now selling sanitizer during COVID, obviously your company is going to make more money now than it would have then before COVID. If you're selling sanitizer before COVID times, your company wouldn't make that much money as it would have now during these COVID times. Partners are jointly liable for the actions of another partner. So because it's a partnership and whatever debt that goes on or whatever debt the company may be in, then you both are subjected to unlimited liability. So if, for instance, like we said, you must focus on the strengths that each partner has when managing the company's workloads. Now, if one partner, for instance, takes up something or a task that they know very well they're not good in, which causes the company or the business to lose money, then the both of you are liable for whatever losses or debt the company is in, even though it may be one partner's mistake. Partners lack continuity, partnership, sorry, lacks continuity. Therefore, a new agreement must be drawn should one partner retire or die. Like I said, if someone in a partnership decides to leave or something, then in a partnership, there is no continuity. So you can't continue the company if one partner decides to leave, or say, for instance, they pass away. The company is not going to continue because you need to draft up a new partnership agreement or something. You must change the form of ownership or now go start a new company with either someone else or with a different form of ownership. Partnership is not a separate legal entity, meaning partners are liable for debt in their own personal capabilities. Like I said, it has unlimited liabilities. So whatever debt the company may be facing, you guys are both subjected to paying that debt, even if it may include taking all your personal assets in order to cover up that debt. Different personalities and options of partners, sorry, can lead to conflict and disagreement. As good as it is to have diversity in the company, sometimes that may be a problem because you may have conflicts in terms of decision making, which may also result in decision making taking time. But apart from that, when you have diversity in the company, it may be a little problematic sometimes, as decisions may not really be agreed upon, because one person may agree on this, the other one may not agree on that, which can be problematic as it may cause or lead to conflicts. Each business partner is legally responsible for the joint liability of the partner. As mentioned above, whenever a partner does something wrong, which may lead to the company being in debt, everyone is jointly liable for that. Again, here it says partnership has unlimited liability. So they may take your personal assets, your cars, your house, anything to pay up the debt that the company has. Discussions between partners can slow decision making down, and they may disagree on important business decisions. As I've mentioned before, like I said, it's going to be a very repetitive chapter, but here it says whenever partners may have conflict or anything, it may result in the slowing down of decision making, or important business decisions may not be agreed upon because of that. And in large partnerships, the partners may struggle to agree on business issues, like I just said right now. When there is conflict or partners don't agree on something, they may struggle to take business decisions in terms of that. It says changes or transfer of ownership can be difficult and may generally require new partnership to be established. So changing a form of ownership from partnership to something else may be difficult because now, especially if you have two partners in a partnership, you may need to have someone else join the company because some forms of ownership may require three or more people to start up. So depending on which form of ownership that you are changing to, it may be a little bit difficult as there are now requirements needed for that, unlike with a partnership where there are no legal requirements needed to start up a partnership. It says losses in profit and instability of the business can occur if a partner dies, retires, loses interest in the business, and or is declared bankrupt. So your business may lose money. Your business or your company may lose money depending on what's going on with the other partner because you are both liable and jointly responsible for this company or the business. If one partner decides to leave, loses interest, or they're declared bankrupt, the both of you are jointly liable for that. So whatever you go through, if you lose interest in the business or you are declared bankrupt, your partner is liable for that as well, as much as you are liable for what goes on with your partner if they are bankrupt, if they lose interest in the business, or if they retire or die, for instance. That's one of the disadvantages of a partnership. Profits are divided between partners according to the partnership agreement and not according to the income distributed. So, according to the agreement that you and your partner make, say for instance, like I said, one invests 6,000 Rand, the other 4,000 Rand to make your 10,000 Rand capital. But according to your partnership agreement on the legal paper that you both wrote down to state that you are partners, this is the mission and vision of your company. The agreement, for instance, may state that you both each receive 50% of what profits the company makes. But because one invested less money than the other one, at the end of the day, it's going to be a disadvantage or it may cause conflict because now you're both receiving equal profits, even though the other one invested less than what the other one did. All right, guys, that actually went by really quickly. So if you have any questions, please do not hesitate to email me, to send a WhatsApp to your class rep so they can communicate with me directly. Um, you can do that at any time. Like I said, I will definitely be available to answering your questions. I will try to get through as many as them as I possibly can. So all you need to do, especially if you didn't understand today's lesson, just please let me know through the emails or let your class reps know. And whenever those come through, they can communicate with me because you may find that sometimes people have the same question. So instead of getting a million emails that are the same, communicate with your class reps and they can communicate with me directly, and I'll definitely be answering those email addresses. All right, we have come to the end of our lesson today. I hope everyone enjoyed it. I'll definitely be posting the slides on the D6 app. I hope everyone has now downloaded the D6 app. This is an app that your parents should have. I hope everyone has that app because most of the work will definitely be uploaded on the app to have. So I hope everyone has that app because I will post this on the app so you guys can have as much access as possible. Thank you so much for watching this lesson. I hope you learned something today. And yeah, enjoy the rest of your day. And I hope to hear from you guys with your questions and your comments soon. That's it from me today, everyone. Enjoy your day and goodbye.